Most beginners waste their first $1,000 on random stocks they saw on TikTok. They gamble, they panic, and they lose. But professional investors don't guess. They use blueprints. And today, I'm giving you the 3 exact blueprints used to scale small accounts from the ground up. We've analyzed the strategies of the world's most successful investors to strip away the jargon and the complexity. You don't need a finance degree or a massive inheritance to start building wealth. You just need a system that manages risk while maximizing growth. In this video, we're breaking down 3 diversified portfolios tailored to your specific risk tolerance. Whether you want to protect every penny, grow steadily, or go for aggressive wealth acceleration, you'll leave this video with a step-by-step map of exactly where to put your first $1,000 to start building a passive income engine. Let's dive in. Look, most people treat their first $1,000 like a lottery ticket. They scroll through TikTok or Reddit, find a hot penny stock, and dump everything in. Then they wake up to a 20% drop and panic sell. That's not investing. That's gambling. And the worst part, it kills your confidence. You start telling yourself, the market is rigged, or I'm just not cut out for this. So you do the safe thing. You leave your money in a traditional savings account, where inflation silently eats your purchasing power every single day. You feel stuck, like you're too late to the game, or your account is too small to actually make a difference. But here is the cold truth. The difference between the person who turns $1,000 into a fortune and the person who loses it all isn't luck. It's a system. Most beginners are flying blind. They have the fuel, the seed capital, but they don't have the map. If you keep guessing, you're not building wealth. You're just hoping for a miracle. And hope is not a financial strategy. Stop guessing. The secret to scaling a small account isn't picking the next moonshot stock. It's asset allocation. Think of your $1,000 as a seed. If you plant it in the wrong soil, it dies. If you plant it in the right one, it grows. But the right soil depends on your risk tolerance. That's your emotional ability to handle your account value dropping 10% in a single day. Depending on your personality and goals, you fit into one of 3 blueprints. Let's break them down. First, the conservative blueprint. This is for the sleep well at night investor. Maybe you're saving for a house next year, or you just hate the idea of losing money. Here is the split. 50% in a high-yield savings account, HYSA. That's $500. It's liquid and safe. 30% in government bonds or a bond ETF. That's $300. These act as your shock absorbers. And the final 20%. Put that in a total stock market index fund. You won't get rich overnight here, but you won't wake up to a disaster either. Next, the moderate blueprint. This is the gold standard for most 25 to 45-year-olds. You want growth, but you aren't looking to gamble. 70% goes into an S&P 500 index fund. That's $700. You now own a piece of the 500 largest companies in America. Apple, Amazon, Microsoft, they're all in there. 20% goes into international markets. That's $200. This protects you if the US economy hits a slump. The remaining 10%, keep it in cash or bonds for stability. This is a set-it-and-forget-it strategy. It's boring, and in investing, boring is usually where the money is made. Finally, the aggressive blueprint. This is for the wealth accelerator. You have a long time horizon, maybe 10 or 20 years, and you can stomach the volatility. 60% goes into a NASDAQ 100 ETF, like QQQ. That's $600. This leans heavily into tech and innovation. 20% goes into small cap growth funds. These are smaller companies with explosive potential. 10% goes into conviction stocks. That's $100 for those individual companies you truly believe in. And the final 10%, high risk, high reward assets. Bitcoin or Ethereum. Warning, This portfolio will swing wildly. But over a decade, this is how you turn a small seed into a forest. To execute any of these, you just need a brokerage account. Whether you use a traditional broker or a robo-advisor like Betterment to automate the process, the only mistake you can make is staying in cash. Now, the biggest hurdle isn't the strategy, it's the tool. To execute these portfolios, you need a reliable brokerage. For long-term stability, I recommend Vanguard or Fidelity. If you prefer a sleek, mobile-first experience, Robinhood is the way to go. If you're still feeling overwhelmed, a robo-advisor like Betterment or Wealthfront can automate the entire process for you. Check the links in the description to get set up in 5 minutes. Imagine the shift. You stop guessing. Your $1,000 is no longer just sitting in a savings account losing value to inflation. It's working. By diversifying, you aren't praying for one random stock to moon. You're betting on the global economy. This is how you turn a small seed into a wealth machine. If this blueprint gave you a clear path, hit that like button. Subscribe for more no-nonsense wealth strategies. Now, go open that account and put your money to work.